Hello, welcome to Business Incorporated. I'm Ladi Williams. Coming up on the show today, Africa Development Bank launches $2.5 billion global benchmark due 23rd March 2026. A United Nations Uganda Equity Bank partner to accelerate attainment of SDGs. And Egypt's central bank keeps interest rates unchanged during March meeting. We begin Friday's show with major markets on the African continent, which were mixed at intraday. The NSE sustained Thursday's positive sentiment, was up 0.22% as investors took position in banking stocks. On the flip side, the GSE in South Africa shaved off 1.09%, and the market in Egypt closed the week negative on Thursday, while Kenya ended Thursday's session positive. And markets in the Middle East closed for the week mixed on Thursday. While the Qatari index rose by almost 1%, Saudi Arabia's market chopped off 1.21% from the index. In the UAE, Abu Dhabi's index declined 0.18%, while Dubai's main index advanced 0.12%. And European markets pulled back on Friday after a spike in bond yields reignited concerns about stock valuations and prompted a sell-off on Wall Street. Well, Conrad joins us now to talk more about this. Hello, Conrad. Good to have you.
Hello, Ladi. Thanks for having me back on Channels TV.
Yeah, thank God it's Friday. Well, the markets in Europe, optimism prevails despite new lockdown measures in parts of France and despite a steep rise in new corona infections in Germany. What's driving this trading this Friday and the last this is actually the last day of the week. So what's driving this?
Well, you know, the AstraZeneca vaccination is back in the game after EMA, the European Medicines Agency, said that the benefits of this vaccine outweigh the risks. The countries that had previously stopped the vaccination with the AstraZeneca jab have taken it on again. And that is, of course, giving some hope that the vaccination can be accelerated here in countries like Germany, for example. What's also positive is, or what is driving stock prices here in Frankfurt is, you know, that we've seen a bit of a sell-off in government bonds yesterday, and that means investors have money that they can spend, and they spend it, between others, on equities here in Europe. We also have triple witching today, which is, you know, the day when many options expire, many futures contracts. Very often large investors try to influence the market at the very last moment. And that is reason why, you know, as you can see, trading today is really a bit shaky.
Yeah, true. Well, bond yields in the U.S. have risen sharply after the Federal Reserve's decision to allow inflation rates to climb up to 2.4% this year. What kind of effect does this have on trading in Frankfurt?
Well, one effect is that equity prices here are getting a bit of a support because money flows out of the bond market into European equities. Now you might say, why doesn't it flow into tech shares? You're right, tech shares were sold off along with US government bonds. The reason for this is that the tech shares had performed so well, and many of those stock purchases in the tech sector were financed with borrowed money. Now, of course, with yields rising, with potential financing costs, credit costs on the rise, investors are getting a bit nervous, saying, well, shouldn't we dissolve some of those trade positions? Shouldn't we just get rid of some of those trade positions that we financed with borrowed money? That's what was happening. Of course, what's also what's this hike in yields is also causing a lot of discussion about what this new inflation target in the United States means, 2.4%. That's quite significant compared to the previous target of up to 2%. It's something that you know, investors try to understand right now, and they don't know really how to tackle this. And that's also you know, one impact on the trading here in Frankfurt. It's adding a little bit to the nervousness and to the uncertain outlook.
True, tech shares did really well last year. Deutsche Bank's shares have been big gainers this week. The share price up 30% on the week. What's behind this?
The investment bank unit of Deutsche Bank is having a very strong start into this year 2021. Revenue is up 20% compared with the first quarter of last year. Remember, last year Deutsche Bank had a bit of a pandemic-related trading boom at the investment bank unit, which helped the bank for the first time in many years to report a positive net profit again. Now, the chief of the investment bank unit says at a conference that the division's momentum has continued. What's also good for Deutsche Bank is a positive ranking for Frankfurt in the worldwide global financial center ranking by the research company Zien. Among the world's financial centers, Frankfurt is on position number 9, which is above Zurich, Geneva, Paris and Luxembourg. For the first time, Frankfurt is among the 10 most important financial centers. One reason for this is Brexit. 60 banks and insurance companies from London have applied for licenses here in Frankfurt because they have lost their passport rights. With Brexit, they don't have equivalent rights to do business in Europe when they are only based in London. And that's a reason why Frankfurt is benefiting, and of course Deutsche Bank as the most important bank here as well.
Well, I guess it's good news for Frankfurt. Anyway, Conrad, thank you for the updates and do enjoy the weekend.
Take care, Ladi.
Thank you. Well, in the UK, the government borrowed £19.1 billion last month, the highest February borrowing since monthly records began in 1993. Let's bring in Juliana now to tell us more. Hello, Juliana. Great to have you.
Hi, Laddie.
Yeah, so while the UK government's borrowing figure for February was highest record in £19.1 billion, it was below the city's forecast of about £21 billion. And Chancellor Rishi Sunak says responding with a £352 billion package of support to protect lives and livelihood was the fiscally responsible thing to do and the best way to support public finances in the medium term. What other sound bites are you getting on this?
Not much, really. It certainly pushed the blue chips down at early trading, but I suppose it's more to be expected, isn't there? This is what we've been going through for the past year. I believe government debt currently stands at about £2.131 trillion. It's an eye-watering sum, and of course it is the public purse that's going to have to pay it back. Chancellor Rishi Sunak has said throughout the crisis that he would do whatever it takes to cushion the blow of the economic crisis that has come through COVID-19, and that's exactly what has been done. As you mentioned, the government borrowing has extended and will be extended over the next couple of months. So we are expecting to see similar amounts in March, April, May and June. It is worrying, which is why when the Chancellor spelled out the spring budget on the 3rd of March, he did say that, you know, taxes will have to rise. I suppose the biggest one is corporation tax, which will be rising from 19% to 25% in 2023, and the threshold for income tax hasn't been lifted. So, you know, we are going to have to pay back these huge sums of money soon, but certainly not now. And I believe that's exactly what most of the rich economies around the world are doing.
True, certainly not now. Well, Britain's Competition and Market Authority has ordered house builders, Taylor Wimpey and Countryside Properties to remove terms in contracts that have made it impossible for homeowners to get a mortgage or sell their properties. That's some good news for leaseholders, isn't it?
It is good news. They've been considered traps over the past couple of years. It has propped up every now and then, which is why last year the government, under the Housing Secretary Robert Jenrick, did ask the Competition and Markets Authority, the regulator, to have a look at some of these what are considered unscrupulous practices from UK house builders. Basically, once they build the home, every 10 to 15 years, they raise the rent. So you're paying so much more on top of your mortgage, and it's difficult to sell these properties. equities because people see these kind of red flags. It's not just Taylor Wimpey and Countryside that are named in the CMA report. There are others, but those are the big ones. And as soon as this was deemed unlawful, their shares fell on the FTSE by about 2%. We got a statement here from the Housing Secretary. He said that he strongly welcomes the efforts by the CMA to bring justice to homeowners affected by these unfair practices, such as crippling ground rents. This behaviour must end, and I look forward to appropriate redress from leaseholders. So basically, what's going to happen now is these UK housing developers, when they build houses, they've got to remove these terms about increasing the land that the house sits on over 10 to 15 years or face legal action.
Interesting. Well, bring us up to speed with intraday market numbers and the outlook for next week.
Well, as I said, the FTSE started off in the red. It looks like it's going into the red for the weekend. The all-share is down 0.43%. The FTSE 100 down also by 0.48%. And the FTSE 250, the domestic market, is down by 0.57%. In currencies, the British pound still rallying against the US dollar by 0.05% at intraday, up against the euro by 0.21% and down against the Japanese yen by 0.01%. We got a busy week next week, laddies. Some important corporate news. Well, first of all, the unemployment rate. That's been a big topic of discussion here in the UK. Currently stands at 5.1%. We're expecting that to come in on Tuesday. That's probably going to be flat. That's the general consensus. Then we've got PMI flash data for the month of March, which is going to be interesting. All economists are suggesting that, in fact, some of the main sectors of services, manufacturing, construction would have all expanded. And then retail sales figures. This is very, very important because we know the British High Street is battling to stay alive at the moment with its fight against e-commerce. Last month it was down 8.2%, but we're expecting an uptick of 4.5%. But we'll be talking about that next week.
Okay, I guess we'll be tracking that. Anyway, thank you for the update and do enjoy the weekend.
You too, thank you.
Thank you. And Asia-Pacific markets mostly fell Friday as investor sentiments turned cautious following an overnight sell-off stateside. Australian shares traded lower with the benchmark ASX 200 down 0.56% at 6,008 index points. The Nikkei 225 in Japan declined 1.41% to 29,792. While the Topix index reversed losses to close up 0.18% to 2,012 index points. South Korea's Kospi fell 0.86% to 3,039, while in Hong Kong, the Hang Seng index fell 1.76% in late afternoon trade. Chinese mainland shares also declined. The Shanghai Composite closed down 1.69% at 3,404. And the Shenzhen Component lost 2.56% to 13,606 index points. And the futures contracts tied to the major U.S. stock indexes rose on Friday after tumbling Thursday as a spike in bond yields fueled concern about equity valuations and prompted investors to sell growth-focused high flyers. Dow futures rose 0.13%, while S&P 500 and Nasdaq futures rose 0.30% and 0.67% each. Investors also digested a mixed bag of economic data on Thursday. Weekly initial jobless claims totaled 770,000 for the week, and March the 13th, worse than an estimated of 700,000. And the African Development Bank has launched and priced a $2.5 billion 5-year global benchmark bond due 23rd of March 2026. The bond, which is the AFDB's first dollar benchmark of the year, represents the bank's largest 5-year dollar global benchmark ever issued, as well as its largest order book achieved for a 5-year benchmark transaction. The FDB's mandate for a 5-year dollar global benchmark has an initial pricing thoughts released at mid-swaps of plus 6 basis points, with the final order book closing in excess of $3.6 billion and 72 investors participating. The success of this 5-year transaction is a clear vote of confidence from investors in AFDB's AAA credit. And we'll bring you more stories from the African continent after the break. Do stay with us. I will take a trip now to South Africa, where there has been blackouts and extended load shedding in some parts of the nation. Our correspondent, Brian Pugani, joins us now to give us a wrap-up of the week. Hello, Brian. Great to have you.
Hello, how are you doing?
I'm fine, thank you. So load shedding has returned to South Africa, and this has been on since March 10th and is likely to last till Saturday, March 20th. What exactly is the problem, and has the government done anything to address this?
Well, we do have a problem with load shedding, but just a couple of hours ago, load shedding has been suspended. So it's been like a yo-yo ride for consumers and the public in general, because we started on stage 2 on the 10th, as you mentioned. Then we moved to stage 1 on Wednesday, then back to stage 2 on Thursday. Then today is Friday afternoon. They tell us no more load shedding till further notice. But it's been an ongoing problem since 2008, which is 13 years, funny enough, eh? But yeah, the main problems which Eskom have been saying is that the old power stations, maintenance, the coal issue, where they're saying their coal is not maintained well and it's been wet, and then there's cable theft and so those are the main issues which Eskom has been crying foul about and saying the grid system is actually on a strain. But yesterday, the Minister of Energy and Mineral Resources, Gwede Mantashe, did announce that the government has acquired 8 bidders, which will help with the supply of electricity to South Africa, which will help with the strain on Eskom, since Eskom is the sole provider of electricity in the country. So we're waiting to see how these 8 bids will go, since some will provide gas power, solar power, and wind energy as well. So, but that's a long-term project which we're all hoping there'll be light at the end of the tunnel.
Anyway, let's look at this 200 billion rand loan scheme, which was established to help businesses struggling to cope with the COVID-19 pandemic and lockdown. It's coming to an end in April. What has been the impact of this scheme, and how are business owners reacting to the scheme actually ending soon?
Well, yes, the scheme has been controversial. It's been mixed with mixed reactions in the business sector, because the scheme was intended for small businesses. But the criteria itself in the beginning was set for certain businesses with a certain turnover, which most small businesses did not meet that turnover which was required. So you'll find out most of the small businesses did not really get the loan scheme and did not really benefit from it. So, and there's been corruption as well with the whole COVID relief funds and the whole COVID schemes. So a lot of these small businesses did not really benefit from them. The few businesses, of course, which did benefit are, of course, crying foul and saying that they don't want the scheme to end now, because their businesses did benefit. But the broader picture of it is that most of the small businesses which this fund was intended for, the people and the businesses did not really get the fund. So it's a mixed bag of reactions from business people, but the majority of them who did not really get it are saying, well, whether it's closed, whether it's open, it doesn't really affect their businesses, because most of the business did close down, so they did not really benefit from the scheme itself.
I can imagine that's quite mixed reaction. So what is the outlook for the country next week?
Well, next week we're looking ahead to the Monetary Policy Committee meeting, which will be happening, I think, on the 25th. So that's what we're looking forward to. So we're just going to find out what's going to happen with the repo rate, which stands at 3.5% at the moment, and the current inflation rate, which is also at 3.2%. Since the lockdown regulations have been eased in the past couple of months, economic recovery is going. So we want to see how the meeting is going to go and how the inflation rate and the repo rate will be changed, or will remain the same. Will there be any improvement? And also some bad news as well for South Africans this week, going into next week. Fuel price going up again. So that's something which we'll be keeping an eye on next week, to see how people react to that, and how goods and services and commodities react to the market as well, to see how, if anything goes up, and how people react to that, because it will be the 4th fuel increase this year, which means every month we're having fuel increases. So people are not happy about that as well. And also just to keep an eye on the on the strengthening of the rand. I think today was the first time it reached the 15 rand barrier mark against the US dollar. We woke up today to the rand at 14 rand 76, which it has been hovering over the 15 rand 50 mark. So hopefully next week the trend will continue and the rand will continue strengthening.
All right, Brian, we'll keep tracking that. Thank you so much for the update. Always great having you.
Always a pleasure.
Thank you. Meanwhile, as the country battles constant power outages, Minerals and Energy Minister Gwede Mantashe has announced 8 successful bidders to produce independent power to provide emergency electricity and help prop up the country's ailing power supply. Mr. Mantashe says the procurement of 2,600 megawatts under the latest bid round for private power producers has gone to the market at midnight on Thursday. Do take a listen.
Evaluation process has resulted in the selection of 8 preferred bids, totaling 1,145 megawatts. Well, that means 1,845 megawatts, and a further 3 eligible bids totaling 150 megawatts. And the 3 eligible bids are subject to value for money proposition in line with the provisions of the request for proposal. It is important to note that these 3 bidders are within the 2,000 megawatts, which is a threshold in terms of the evaluation rankings. But the announcement can only be made following satisfactory value for money proposition. It gives me pleasure, therefore, to announce the following 8 preferred bidders in alphabetical order. Now you listen carefully. 1 is Aqua Power Projects DAO. Second is Car Power Ship SA, Kuka. Power Ship SA, Richards Bay. Key Power Ship SA, Saldanha. Mulilo Total, Kuka. Mulilo Total Hydro Storage. Oya Energy Hybrid Facility. Umoilanga Energy. Those are the 8 preferred bidders.
And moving away from that, the Monetary Policy Committee of Central Bank of Egypt has kept overnight lending rates and the rate of the main operation unchanged at 8.25%, 9.25% and 8.75% respectively. The statement released, the MPC clarified that the annual headline urban inflation inched up to 4.5% in February 2021 from 4.3% in January 2021, attributing the slight increase to the unfavorable base effect and reflected in the higher annual contribution of non-food items. According to the MPC, real GDP growth at market prices increased in the 4th quarter of 2020 to 2.0% from 0.7% during the 3rd quarter and a contraction of 1.7% in Q2. Meanwhile, the unemployment rate broadly stabilized at 7.2% during the 4th quarter 2020 compared to 7.3% in the 3rd quarter of 2020. And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Enjoy the weekend.